Welcome to the Millionaire Journey Podcast. The goal of this podcast is to guide and empower you on your journey towards financial independence. Here's your host, Glenn Yaney.
Today, my guest is Shaun Magner with Monument City Capital. Welcome, Shaun.
Thanks, Glenn. Well, happy to be here, buddy.
Yeah, I'm glad to have you on. As we met friends of Jeff Everick. He was also on the podcast. He introduced me to you, and I've always been interested in private lending and spoke to you last week, and I'm excited to have you on for today.
Excellent. Well, I'm happy to be here.
So if you could just tell us a little bit about your story.
Sure, man. So I often explain that I run a boutique real estate collective, meaning I own a few different real estate investing businesses, primarily these days focused on hard money lending, private lending. For those listening that are unfamiliar with hard money lending, it is I best describe it as short-term interest-only loans for the acquisition of and renovation of investment real estate for real estate investors. So we kind of meet at the crossroads between private money and a bank, exclusively for the residential real estate investment space.
Yeah, so tell us about how you actually got into real estate, because I know you told me you had a handful of houses. I'd like to hear how you even got to that point.
Sure. Back in 2015 or 14, I was driving down the road and I responded to one of these ads on the radio for a real estate investment education seminar. I attended it, I listened, I took action, and I started networking and meeting the right people locally. And I bought my first fix and flip property in November. I put it under contract in November of 2015. I bought it in January of 2016. Fast forward 6 months, I sold it for a profit of $21,315. I'll never forget the number. But more importantly, I had met a new mentor in the meantime who introduced me to what's now called the BRRRR strategy: buy, renovate, rent, refinance, and repeat. It wasn't coined that back then, but I think Bigger Pockets coined the acronym. But anyway, he introduced me to this concept because I thought I would have to flip, maybe buy a rental, do some flips to produce some cash to buy rentals. He introduced me to this concept and strategy. And so the time I sold that first flip, I had 6 rental properties under construction or under some stage of the BRRRR process. And in that first 15 months, I had acquired a portfolio of 18 rental properties. And I was kind of off to the races. And I've kind of always been a planner for the future. And that's my focus on the residential real estate space was always rentals over any other exit strategy because of the long-term wealth play. And obviously all the benefits that come with it along the way.
So what made you pivot into getting into private money lending?
Great question. So I often say this: I've tried on, outside of new construction, I've tried on all of the residential investment strategies, from wholesaling. Those are the We Buy Houses signs, if those listening are unfamiliar. From wholesaling properties, finding motivated sellers and selling those contracts to motivated buyers, fix and flip, buy and hold. And a few years ago, I think it was 2021, I was going to do a big refinance of about 30 of my houses. I refinanced about 30 of my properties, did a big cash out refinance. And I was about to become a new father at the time. And so I had to kind of think differently about what to do with the capital. And I could have just self-funded my own deals and driven down my own cost of capital. But I decided at the time was right for me to entertain throwing a different and new fishing line in the water. And I sat down with a lot of different people. Let me back up. When I did this refinance, I was going to cash out a few $100,000 tax-free money. And so I wanted to be a good steward of that. So I sat down with a number of different people. And I have a picture of the whiteboard of all the people I talked to and all the things we talked about. And the 2 people that resonated most with personality, lifestyle, worth, all of that were private lenders. And one of them said, you should put that money to work on the street in a hard money business. I run a pretty sizable one. He's a big lender locally. And he peeled back the curtain and let me see the inner workings of his business. And to this day, he's a big investor in my business, interestingly enough. But also, he's helped me to connect those dots. And I was best suited, of all the exit strategies in the residential real estate space, this one fit me the best. Meaning my skill sets and my passions are in the boring spreadsheets, line items, underwriting, and being kind of in the office as a real estate operator, not out in the field. And I just like this one a lot. And plus, you've got to think, 8 years or so leading up to this, I raised a lot of capital. I learned how to raise private money. And I built a big network of people that would then come to me to borrow. So I kind of stand at the crossroads of raising money and being able to deploy it. And that's a pretty important piece. So my resume kind of led me to this, but it's the business model in the residential investment space that I like the most.
Crossroads of stress.
Well, yeah, there's a lot of that.
Yeah. So the crossroads of, for me personally, we also raise capital. And when we have these We have investors, always want to make them happy. You have lenders, always want to make them happy. And then you have the operations, the residents that you have to work with. For us, it was rentals. And you're trying to make them happy, but at the same time, you're just trying to make sure the revenue, the bills are paid, and it's got to be a fair exchange, really.
Yeah,
And
you're right.
I 100% could see why somebody would go private lending. I think it's eliminating a lot of the variables. The main goal is to have a certain type of income, and you're well protected.
I mean, yeah, you're right. I try to reduce friction at every point, right? So what you're saying with stress, that year that I started the business, maybe it was the year before, I hired an assistant to manage my rental property portfolio as it relates to vendor communications, tenant communications, program, Section 8. We have a lot of subsidized properties. That probably bought me back 20 hours of my week. I also hired a new bookkeeper at the time and got off of spreadsheets and onto QuickBooks Online, and that probably bought me a lot of time back. And so I was reducing friction at every step. And that allowed me to be focused on the hard money business. And this one, when done right, is the most passive and has, there's still a great amount of risk because we are putting up capital, but it's collateralized conservatively and in a safe way that we remain safe. But I tell you, these days, Glenn, most of my stress comes from my rental property side. And I might deal with that a couple hours a week, right? Just responding to her, my assistant, Sylvia, who's been with me for 3 years, just responding to her, some of the things she deals with that I learn about kind of stress me out. But otherwise, I don't feel stressed these days very much in the lending business.
Yeah. So let's talk about lending. So you focus mainly on construction loans for house flipping?
For the most part, yeah. It's for house flipping and the buy and hold investors that are doing that BRRRR strategy. So right now, about 2/3 of my loan portfolio, my outstanding loan portfolio, are for BRRRRs. These are buy, renovate, rent, refinance, repeat. So these are folks that are buying value add real estate. So things that are in distress that need some improvement. And then refinancing. About 1/3 of my loans right now are for the more commonly known fix and flip. And that varies. That pendulum shifts from time to time depending on the market. As the market's shifting right now, rents have crept up, rates have stabilized, and I'm seeing a lot of people go back to doing more BRRRR stuff. But yeah, we do a lot of value add, fix and flip, fix to rent for residential. So 4 units or less. And we exclusively operate in our home market of Central Maryland and Baltimore Metro and South Central Pennsylvania.
So with that, thinking about like the investor side, I know you work with friends and family, but what kind of returns do they generally, like how does that work out for them?
Great. I mean, that's a good question. Let's get right into it. I pay my capital. Those folks are called capital investors, right? Friends and family that invest in my business. And they invest in my business for a number of different reasons and through a number of different vehicles, RAs, trusts, bank accounts, right? There's lots of ways that they have capital they move over. Collateralize their investment against my loans. But what do I pay them? I pay them 10% interest and I disperse monthly. So it's 10% annualized, dispersed monthly. So if they invest $120,000 in my business, they'll get $1,000 ACH every month.
And with that, I've always thought, because this is when I talk to the house flippers, and I'm not considering, I know this is not the same, but they always have this like, oh, we'll give you 18% return, and then we'll only need your capital for like 6 months. So then you're left with idle money. Is that the same effect with the lending, and how does that work?
It's a really good question because people, when they put their money to work, they want it to remain in play, right? They want to they get on that mailbox money, that drip, and they just want to stay there. If I paid them back,
they don't want to be active as well.
No, I'm pretty passive. They want ultra passive. So
exactly.
In order to achieve that, what we do, our business is unique in this way. We require that our initial term with our capital investors be 12 months. Our loans with our borrowers are 6-month loans. And I can go into that too, but 6-month loans, we offer extensions and sometimes they go longer than 6 months. Since my loan volume is such that I have payoffs and new fundings happening regularly, I can always keep their money in play. So I pay them, I require the 1 year commitment. We pay them monthly each month for the first year, but I've only had one person pull their mony back actually. Most of them stay in for years afterwards. So I don't know how they can even guarantee an 18% return. That we couldn't. I don't even charge 18%. I don't know how I could pay, that's a big number. I'd be curious to hear how they're structuring that 18% promise. But to your point about the 6-month thing, I mean, here's what got me into this hard money business. And this calculation is pretty wild. And I don't know if you and I talked about this last week. Maybe we did. But I built out a spreadsheet, a calculator, and it really just floored me. And I had a bunch of people smarter than me fact check it because I'm like, can this be real? But I used an example. This was an older average number, but I used an average loan size of $140,000 in which I would participate $40,000 and my capital investor would participate $100,000. I promise I'm going somewhere with this. In the course of, say, 8 months, let's say I paid that capital investor back after 8 months, gave them their $100,000. Well, they made about $6,600 or so, right? That's not what they want. And in that same term, I mean, I can share all the details, but it ends up being that I made about a 35 to 42% annualized return, and they made a 10% annualized return that I then turned the faucet off on them in 8 months. That's not how I build this relationship for the long haul. They're not going to want
No,
that. They want to set it and forget it. And so
exactly.
we can keep it in turn by, as soon as a loan pays off, we put a new loan, we collateralize, we move them on to a new loan. That's outstanding. And also, another big piece that I need to mention is that I'm not well diversified. I'm not a fan of diversification, quite honestly. I'm more a fan of control. A lot of real estate investors are. I don't own stocks. I don't own crypto. I've avoided a lot of those shiny objects. But here's where I'm going with this. I only invest in real estate and my private lending business. And I haven't bought real estate in a few years. So I just reinvest. So I'm in there with them. And for that reason, if a new investor comes in and they want to come in today, they can, because that will just free up my own capital that's already on a loan to bring their capital in, put them on that loan, so I can go out and say yes to my next borrower. So since I'm reinvesting in my own business, I'm able regularly, as my primary investment vehicle, I'm regularly able to continue to keep their money in play.
Yeah, and I've been thinking about this a lot recently. We have a few properties that we had to stop distributions for. Obviously not favorable when you do that, but at the same time, it's like you're trying to really make sure that the asset's safe. But I also have my own little promissory notes where for me, I have like whatever, $500,000 in promissory notes on on some of our properties. And those notes are the ones that are kind of like, it's like that's keeping the cash flow steady. You know what I mean? So like my cash flow might have gone down on the equity deals, probably, 25% because we stopped a few distributions just to make sure that these properties are safe. But because of the way these are structured, these promissory notes and stuff that we have, it's like those always get paid first. And I think that that's the idea that I really like about first lien lending. And, my promissory notes are in second position. So it's like I would even making, on my promissory notes are like 12 to 15%. There would be even more of a warmer blanket if it was like a first lien. Worst case scenario, the property gets taken back. That's like the last thing anybody wants to do, lender, borrower, anything. So everybody's working together to make sure that doesn't happen. But at the same time, you're in a very well insulated position. And I really would not, that capital is protected ideally with the correct collateral and how it's built. So I think it's great. Also, the theory I keep thinking of is that this is, even though these are long-term partners for you, it's a short-term agreement. We have like 1 year that we're like, hey, let's work together. When you get to the equity, it's like 3 to 5 years as long as the deal goes well. And which in my opinion, the equity deal very well should make more than 10%. But you have the thoughts like the market's up, tariffs are happening, this is going on. You're like, is the market, we don't know what the market's going to be in 5 years. But generally, you have a better understanding of where we're at within 6 to 12 months. So, and you're protected with the right collateral. So it's one of those things where these high income earner, professionals and entrepreneurs, it's like you want to have some liquidity, but it doesn't need to look like they might not need the liquidity today. Right. So I like the private money lending aspect of it because it's like, look, if it goes, a year, maybe even 18 months, at least it's like, we're going to get this capital back and it's going to be cycled through. You'll have this money back to go take your next venture, whether it's start a new business or, go ahead and reinvest it. You have the decision. Let's go ahead and reinvest it, and we can move forward from there. Yeah. And that's been my thing. It's like, for me, I like the IBC. I've had a few podcasts on it, which is infinite banking concept, which also gives you you have this capital available. And then over time, you can build up your cash flow to be able to pounce on the bigger ideas. Like, so with, some of the high net worth investors that I work with, it's like they have $1 million ideas. So like that capital and they're not comfortable with it just staying as cash. Right. But do they lock it up for 3 to 5 years, or do they go for like a 6 to 12 month time frame that would make more sense to them? That's kind of what I've been thinking about a lot with this private lending.
I mean, you're thinking the right way. I mean, I often tell my capital investors, look, if something happens, if you can give me 30 to 60 days, 45 to 60 days, I can be liquid again because my loan volume is such that I've got some payoffs coming in. So if you tell me, I'll stop committing to the new loan if I need to get liquid, say no to the next borrower that comes in so I can return it. And the other point that you made couple points there I want to speak to. Depending on how you structure your hard money business, you could do what's called a co-lender agreement where you're both lenders on the deal. You're both sharing a first lien. You're both in, but the problem there is if that borrower stops paying, the capital investor is not getting paid either. Just like what you mentioned in your deal, you had to stop disbursements. So they're in there with you. They are a lender with you. They're truly co-lending. So if they default, if the borrower defaults and you take them to a default interest rate of say 24%, you're going to give some of that to the capital investor. You're going to get some of that yourself. If they stop paying, you don't disperse that month. That can be a problem. So what we do in the first lien lending position, they're not a co-lender. I've already funded the loan. I've already done the loan. I'm just going to assign some of my interest in that loan over to them as collateral so that I stay on track here. I keep control of it. Now, if that deal that they're collateralized against were to go south somehow, this is what I love. One of the things I like most about this. Let's say that deal were to go south somehow and I talk to them and I tell them, hey, look, this deal, the borrower's not paying. I can move them onto a different loan that is performing. Yeah. And if I use this analogy, it's kind of a silly one, hasn't had to happen. But if the boat is circling the drain, I can let them off before it goes down, right? Because I'm my own lender in this business too, which is a big, big deal. I can just take it on myself and move them onto something else. So we don't ever stop the clock in the way that I'm structured. And I can share more about our structure, but because there are different ways to do this, right? You can set up as a debt fund, an SEC governed debt fund. And then you don't, there's a lot of different ways to do this. I won't go into the weeds on all of them, but I'm with you that it's a short-term kind of a commitment. But once they get on that 10% drip, it's often just too good to be true. I had a capital who came in for almost $1 million, $990,000 over the course of 5 different slugs. He was paying off some treasury bills that were coming due. And he's like, so you're telling me you're going to pay me 10%? I've been getting 5%. You're going to pay me 10. I said, yeah. He said, if I give you $1 million, you're going to pay me $100,000 a year. I said, yeah, because I'm also going to make $100,000 a year with it. So you're right. That's exactly what I'm telling you. And so, now he's been in for a couple of years and he's got a 6-figure income in a 100% passive way. I mean, he has to check monthly just to make sure the money hit. That's his involvement.
Yeah.
That's it.
Hey guys, if you want to learn more about our deals we're investing in, go to our website and sign up for our free ebook, 10 Reasons Mobile Home Parks Outperform Other Real Estate Investments. We won't spam you. We'll just keep you updated on the podcast and the deals we're working on. Now, back to the show. Let's talk about the thing you were just talking about, because that's probably like, how does that work? So we talk about you're selling shares, say there is a default. How do you cycle out an investor to go to another loan that is paying to, how does that work? How would you structure that?
So I want to back up. I'm not selling shares. I can't say that because I'm not a debt fund.
Okay.
So we're not selling shares. So what I'm doing is I'm collateralizing their investment with a piece of a loan that I've already done. In some cases, it's the entire loan, but I'll assign my interest in it. So there's 2 documents that are actually type of basically 4, but 2 different sets of docs. One is an initial agreement between them and us. So one time we sign it, kind of a broker and sales agreement, if you will, set a broker and servicing agreement, set that on the shelf. That's a one-time ever relationship thing. And then when I do a loan and they want to move money over, let's say they move over $120,000 on July 1, I will sign 3 different documents: a promissory note, confessed judgment promissory note. So I am personally guaranteeing this debt. So it is a recourse loan. But then I also assign what's called an allonge to the promissory note. So giving them rights to the same rights that I have with my borrower's promissory note. So when I say an allonge to a promissory note, I'm talking about the one that I have with my borrower that they signed at settlement when they bought the property. So they have an allonge to that promissory note. They have a bill of sale and then an assignment of the deed of trust. So I assign some interest to them. They hold on to that. I have it signed and I'll notarize it and I'll give it to them, the original to them. And they know that if something were to happen to me, I get hit by a bus. That's a dark analogy I use all the time. If I get hit by a bus, they can just go record the documents that they have, and now it's on record that they have a stake in that particular loan. To your question about if something is a loan is not performing, how do they get paid? Firstly, they get paid no matter what, because the way that we're set up, my personal guarantee, I pay them every single month. It's not yet where I've paid out more than I've brought in, but in the event that I have a borrower, and in fact, it did happen this month, a borrower had an NSF on a few of his payments. And so the money, meaning a non-sufficient fund. So his payment hit my account, but then it got pulled back from my account. My capital investors will never feel that because their money hit. Yeah. And they'll never feel it. But how it would work is I would simply assign those 3 documents that I used. I would assign them I would fill out those 3 documents for a different property and a different loan and assign them and just replace the other one, because none of this is being recorded at the courthouse. I mean, until they need to. When I say none of this is being recorded, the original loan with the borrower is, of course, recorded. That's all on record. But the agreement that I have with the capital investor doesn't get recorded. So we can shred the original document, put them on a different one, and a different loan, that is, and they'd be they would not feel any of that risk. But regardless, they don't feel the risk because we guarantee it. So I pay them despite despite my borrower's performance, my performance as my capital investor is guaranteed with personal guarantees.
Exactly. The part I love about that structure is that your reputation is not based on, I mean, your goal is to have good borrowers, but they can go south and it doesn't sync with your reputation as well. It doesn't take down your own personal reputation.
That's right. Yeah, that's exactly right.
Awesome. So as I'm listening, I just think of myself as an investor and I just start to kind of not poke holes, but it's more of like let's figure out like how you're protected. So you personally, because we want you to do well, I never would want somebody to do bad that I'm giving money to. How do you protect yourself from a bigger event where, a handful of people do you just have like a large reserve? You just have a plan to have a large reserve in case, say, there's like more than normal amount go default?
It's a good question. I do have a reserve in my business. It's a couple six-figure reserve. I've never really needed to use it, but here's how I protect myself. When I say conservatively underwritten real estate, that's what I mean. So when a hard money loan, we determine a loan amount based on the potential value of the property, right? So it's not just on a borrower. It's not like Bob is qualified for a $200,000 loan. No, Bob needs to check out, and so does his deal, right? So those deals, ARV is an acronym for after repair value. So what the property will be worth when it's renovated. And we will lend up to a certain percentage of that, right? So there's the difference between, let's say it's 70% loan to value, 65 to 70% loan to value. So if it's going to be worth $200,000 when it's renovated, the biggest loan I will give anybody for both the acquisition and renovation is $130,000 to $140,000, 65 to 70%. Why? Well, because I'm going to come back to another point about the rehab. That 30 to 35% delta is our safety threshold. In the event that something were to happen and I had to take the property back or foreclose on it, it's going to cover all of our costs and we're not going to lose principal fully, right? I say that because that would be a catastrophic, not a catastrophic event, but that would be a worst case scenario. Hasn't happened and we don't get close to it because we conservatively underwrite. I monitor that number very closely. What do I mean? We underwrite at around, when we do a loan, we fund a loan, we are funding right now around 65.3% loan to value. So we're on the conservative side. When a loan pays off, I always ask the borrower, hey, what did it appraise for if it's a refinance? Or I can track public records. I can track what it sold for so that I can track how close we were to accurate. And our true LTV is around 63.5% LTV, which means these homes are selling for or appraising for even more than we originally thought they would. So we just remain conservative. Since I track those two numbers, if I don't change anything in my process, if that delta starts to shrink, I know that the market is changing around me. If I'm not increasing my LTV exposure, if I'm not underwriting them differently, then I know something is changing. It's a good way for me to keep my finger on the pulse. So that's one thing. The other thing I wanted to come back to on the rehab piece, a lot of lenders have deal killers, right? Meaning things they won't touch. I don't like waterfront. I don't like double yellow lines. I don't like rural with well and septic, right? There's a lot of people have different deal killers for different reasons. A lot of times from a negative experience in the past. But one of a lot of deal killers, a lot of investors or hard money lenders don't like the upside down loans, they're called, meaning the renovation budget is greater than the acquisition price. I love those loans. Well, let me explain.
There's a lot of equity.
There is, but I also like that my own rental property portfolio. I own a lot of subsidized Section 8 stuff in Baltimore City. I bought most of those for less than what I put into the renovation, right? I buy them for $50 and put $75,000 into the rehab, and they're worth $180 or $200,000 or so. So some people don't like that. I do like that, and the reason I like that is if I do a $100,000 loan, this is the best part. This is called Dutch interest. I learned this term a few years ago. When a borrower is paying interest on money they haven't yet received. So it's not a line of credit like when you draw on a home equity line where you're only paying on the money you've received. They're paying from day one the full 12% interest we charge our borrowers on the full loan amount. But I'm holding back that construction escrow. So let me give you an example. In the case of that $200,000 ARV, if I agree to do a $140,000 loan, which I wouldn't because that's 70%, we're going to be closer to 130. But let's say I do a 140 loan and it's towards purchase, $80,000 towards the purchase and $60,000 towards the renovation. Well, I'm only releasing $80,000 minus my fees and points and stuff that I collect. So the net wire, the day of the funding of the loan, is about $70,000 or so, let's call it. So I'm sitting on that other 60 to release as they make progress on the construction.
Yes.
So I'm in a really safe position. They've bought it well because these are operators that are buying well below market value, these investors, because a lot of them have unique acquisition strategies by going direct to the sellers with their marketing and buying from wholesalers or off the MLS maybe. But there's a safety measure there that I like, that as they progress in the construction, my loan gets safer. But from the onset, I'm controlling all the capital. So in the event that, or my loan gets safer, my loan is safe from day one. I just like that. I like those upside down loans because I know that market very well, but also I'm not releasing so much of the money. I've got some of my friends that do lending that they don't like to do rehabs. They just only like acquisition loans. I'm like, no way. If a borrower tells me he's got 50 grand cash, he's going to put that down towards the purchase and I'm going to control the rehab, because that way I can control and know that progress is being made, right? Some borrowers will say, well, Shaun, I'll take your loan for the acquisition and I'll use my cash to renovate it. Well, how do I know that guy doesn't have a gambling problem? How do I know that guy isn't going to be taking the $50,000 that he promised to renovate his house with and doing something different with it, buying his wife a car, doing a different deal? I don't want that risk. So I like to control the renovation. And so that's another safety measure.
So let's just do quick numbers real quick, just because I kind of feel like just to make an understanding. So there's a chance that you actually, so the borrower is going to put down how much towards the purchase price?
Good question.
But at the closing table, where they put about 25%, 30?
No, but at the closing table, they usually bring around 10%, give or take. In
10%.
Some cases, it's none, right? Depending on how well they acquire it.
Yes.
Because I will fund up to 100% of both the purchase and the renovation, as long as it respects my 65 to 70% loan to value threshold. But on average, our borrowers are probably bringing around 10%, maybe 15% of the acquisition price to settlement.
So then, okay, so now they're going to renovate this property, and then you will go through, inspect the property and get the receipts, whatever, and then release the funds. So there could be a chance that they'd have really very little to no money down, but your value is that you are trying to stay under 70% or 65 to 75% of the value. So you pretty much become I'm just talking this through. So you become the business partner for this person, advantageous to them because they're going to try to they're swinging for the fences, and you're just going to make sure that you're protected by making sure that the equity is being built in as you release these construction loans or
Absolutely.
Funds.
Yeah. I mean, the process
that makes
works,
a lot more sense.
Yeah, they're going to give me, I collect a lot of documents up front. We're not a bank, so we don't collect like tax returns and personal financial statements, but we do collect financials. We want to see, based on our average loan size and our average split between purchase and renovation budget, we want to see that our borrowers have around 40,000 cash liquid. Usually about 20,000 of that will go towards the acquisition, whether it's down payment, closing costs, fees, whatever the thing is. There's cash to close is usually around 20,000, give or take. Some are more, some are less, depending on the loan size, of course. But I'm just talking about our averages. That other 20,000 that I want to see in reserves is to get the construction started. So my money's never going to be out in front of the construction. They need to have some reserves to start the construction. They're going to give me a scope of work saying, here's what the $60,000 renovation budget's going to get me: new roof, new kitchen, bathrooms, floors, paint, whatever. And then alongside that scope of work, they're also going to produce a draw schedule saying, at these milestones in the scope of work is when I'm going to call you and say, hey, we're ready for a draw release, a draw inspection. A draw inspection is when they'll call me and say, Shaun, we've made progress. We'd like to have you come out, take a look at the progress we've made, and release some of the money. So that's when I do what you just said.
Awesome. Makes complete sense now. As I was like walking through, I was like, hold on. Okay. But yeah, and I could see why the borrower would want to do it, just because it's like they have experience, they know what they're doing, they bought it right. And you're pretty much just, all you're doing is just protecting yourself through having the correct amount of collateral. If there's a shift in the market, goes down 10% for whatever the reason, you still have another 20% to go.
That's exactly right.
20 to 30%. Yeah.
And so there's a few things here. Number one, it's real estate. So we're going to see it coming. It's not going to happen overnight, right?
Yes.
Elon Musk can't tweet something and the housing market go to hell, right? It can't happen, right? Yeah. The stock market, we've seen that happen. So that's not going to happen. We'll see it coming, and we might still get hit by the wave if we don't get out of the way completely. It could happen, but we'll see it. The tides of real estate don't change overnight. I guess I should say it that way. Also, though, one of the reasons that the borrowers like to use hard money, and I probably did 80 or so loans with my primary hard money lender when I was buying real estate. Speed and ease is the name of the game. So when I say speed and ease, and also I'll come back to that in a second, but leverageability. One of the great benefits to real estate is how highly leverageable it actually is. My dad, as a veteran, he could buy a house with nothing down. Where else could you do that? Tell me a stock you could buy with nothing down. Show me a piece of gold you could buy with nothing down. It doesn't exist. With real estate, it's a highly leverageable asset class. Number one. Number two, back to the ease, speed and ease. Last year in 2024, I funded 4 different loans. I think I might have shared this with you. I funded 4 different loans within 24 hours of them first being presented to me. So somebody calls me up and says, Shaun, some financing fell through because it's real estate. So there had to be a bunch of stuff that happened, like title work, insurance is in place, title work's in place. We can produce documents, the loan documents in time. So the stars needed to align to some degree. But there's not a bank in the country that could say what I just said. That within 24 hours after a borrower called me, money left my account. That's bananas. So speed and ease. We make their life easy. And I have one of my top borrowers, he's become a good friend of mine. He has said to me, he's like, Shaun, I know there's cheaper money out there. And there is. Banks are far cheaper than me. There's other lenders that are probably right in that might shave a point or so. There's not a big difference, but the ease of which I make his life very easy. His draws come immediately. If he calls me for money, it's there. If he has a deal that needs to be funded, I say yes, because it's a relationship that we have. But speed and ease and the highly leverageability, the high leverageability component that is real estate. It's one of the beauties of real estate. Also, the tax advantages that come with real estate are another big perk, but the highly leverageable piece is a big deal.
Awesome. Well, it's a great podcast. I feel like I could talk to you for another hour. Thank you so much for coming on the show.
Of course, man. Happy to be here. Thank you for having me.
Thank you for listening to the Millionaire Journey podcast. Please rate, like, subscribe, leave a comment, and share with somebody you think would enjoy listening.